Gang, okay, and non-gang members, welcome to my YouTube video. I'm giving you an update on the market and what I think is going on. First of all, let's do a little bit of history. In August of last year, which was just around the corner, we had a little hiccup with Japan, and this dropped. And then in January, we had another little hiccup right here, and we had a 14% drop. Both 14% drops. This was far worse right here. This is when we had the drop when it was announced that Great Britain was going to leave the EU, and we only had a 4% drop. Now, you would think that this drop, because of a 25% increase in rates in December, that's how it took it. One of the worst Januaries in history. Are you telling me that that's much worse than where Great Britain left the EU? Are you kidding? No. What they do is they come in and financially engineer the market. So what they do is this. We call them steel-eye beams. They come in and they take and make sure that the market doesn't go down. The plunger team does that. Now, how do they do that? Well, over here you have what we'll call the bond market. Okay, so let's say this is the bond market right here. So the bond market, the Federal Reserve will come in and buy all the 10-year treasuries it can. Now, why does it do that? Well, because last year at this time, the yields were 2.4%. Okay, they do that because the institutions, the big guys rather, not the institutions, Saudi Arabia, China, other countries, they come buy our debt. Now, they buy our debt because they want the interest. Okay, so as you know, when you buy bonds, everybody buys bonds, bonds then go down. Okay, and we're now at 1.3%. Okay, so that's a big move, huge move. Now, what does that do? Well, the price, as you know, goes up. So people are thinking they're making money, okay, as the price goes up and the yields go down. But the problem for folks is this. They're nuts going in and buying bonds because they're nervous about the economy, and they should be nervous about the economy for a very good reason, because all of our economy, when you look at durable goods, you look at investment, you look at business spending, you look at manufacturing, productivity, earnings growth, everything is so negative. But they've been able to hold this last rally up here, okay, by, as I told you, buying 10-year treasury. So they put these what we call steel-eye beam pattern in here, hold it up. Now, so anybody who's buying bonds is going to get killed because you're buying what we call a real overvalued market. You should be buying gold. Why? Because gold, if you look at gold, gold is not overvalued. Okay, gold is not overvalued. So here's your gold. If I look, let's put in perspective. Your gold is going up this much. Okay, and let's say the top of the market is, let's say right here, the gold market, top of the market is up here. Now let's take the bond market, okay, the treasury market right here. And the treasury market is already up here, right to tippity top. So the bonds are overbought, okay? And that's what you see when you see the yields going down. When yields go down right here, from, let's say, from your, just to say from 2.4% from last year, a year ago, 2.4, okay, and I'm just guessing at it, pretty close, I would think, to 1.3. Now, what does that mean? Well, when yields go down and the price goes up, people who are buying bonds are happy, but the people that aren't buying, the people who buy bonds to buy our debt, Saudi Arabia, China, other countries, no, they want this kind of return. They don't want 1.3%. So the problem you're having is the stock market is stuck here. They're trying to hold the stock market up. So how do they hold the market up? Yellen goes in and brings out the printing machine, okay? And she brings the printing machine and she prints all kinds of money, and she goes in and buys even more bonds, which drops it even further. The reason she does that is so the countries who buy our debt not attracted buying our debt to get a 1.3% return. They know that. So they do that so that they'll come out of their bonds, and they'll go and they'll buy stocks, and that's what holds the market up. So what they've been doing is artificially hold the market up by continuing to drop the bond yields by yelling printing money and going in over here, okay, and keep purchasing these guys right here. By doing that, the yield goes down. Now, people are happy because it's going up. They're making money. But people are getting in right up here at the tippy top rather than be buying gold, which is crazy, okay, because here's the top for gold, we'll say, nowhere near it. Okay, so that's what they're doing. Now, that's causing a bit of a problem. Why? Because what's happening is our stock market now is in what we call a sideways consolidation, and you can see it. Okay, you can see it just from last year, about the same thing we had last year. See it right here? So we had sideways consolidation here and a sideways consolidation in here. So if we did it this way, we're right back to where we were. So we're in what we call a consolidation. Now, why can't they break it out? They can't break out and run because too many people, okay, they're taking their money, and what are they doing? They're taking and they're buying bonds, not stocks, okay? So that's why there's no money. So if you look at the institutions, the 401ks, there's a lot of money coming out of 401ks. Everybody's pouring out of the stock market to buy bonds and to buy what else? Gold. So the stock market's been up here for 14 months going sideways. 18 months going sideways. Market goes 18 months sideways, that's bad news. That means that the big guys, the big investors don't want to buy because they know that there's a huge bubble. They also know the reason why the market's not going up, they're not putting money in the market because we have terrible debt. The country owes too much money. In one day, our debt went up $100 billion yesterday, I think it was, or today. And so, and foreign policy is so bad, everybody's nervous, so they're not buying the market. And so we got all kinds of money coming out of the market, but you don't see it in the market because it's being held up by the steel I-beam, which is created by taking all this, getting people scared, dropping the yield by buying it, dropping the yield, and then the countries get out of the bond market, and because they don't want to be in there for 1.3%. Are you nuts? So they move from here over here, okay? And that's why your market's being held up. That's what it is. That's simple. Now, what's going to happen? Well, there's an election going on. They got to break it out. Well, what usually breaks out the market? What runs a market up normally, okay, we had a market go up. We had a stock market go up, remember, like this. From 2009, we were now flat up here, 168% rally. And what's supposed to move a market up is growth, is earnings revenues, okay? Earnings growth. Companies making earnings, companies making profits. Their margins are getting better. Their top line sales are getting better, but they weren't. So that's why they used QE starting in 2008, okay, QE. They did QE 1, 2, twist, and 3, and then they stopped in 2012 right here. That's where they stopped, okay? But they knew the market was going to collapse because every time they stopped the QE, the market pulled back. It pulled back, pulled back. So they did strong stock. They printed money, more money. They did is they brought the printing machine in right here. They brought the printing machine in, printed more money, gave to the companies. Okay, gave to the companies over $5 trillion, okay, to buy their own stock back, to push the stocks up because there was no profits to push the stock because the economy's doing terrible. So they gave 0% money to companies to buy their own stock, and they also printed more money and gave $3 trillion, to the Give $3 trillion to the banks to go in and buy stocks. So this is all called QE, all right? So they kept on printing all this money, buying bonds, stock buybacks, all this stuff. And now this is done. They're not doing this anymore. They're not doing this anymore. Actually, these two here were done down here. Sorry about that. 3 trillion. That all stopped in 2012, and 5.5 billion all stopped in 2012. This was all just stock buybacks, nothing but stock buybacks. So now how do they move the market up? Well, they can't, because earnings are going down. Earnings are terrible. There's no GDP economic growth, no earnings. The only way they can move this market up, and you can see it over here, is by breaking it out with another QE. See right here? And that's where they did $85 billion in bond buying every month. So to drive the countries who buy our debt out of the bond market into the stock market over here, right? They did the same thing. And then they put the $5 billion in, they gave it to the companies buy their own stock. They put in another $3 trillion to make the stock market go up. They got to do the same thing now right here. The only thing they're doing now is buying bonds. So the next QE will be more of this right here, stock buybacks and injecting money into the market directly. So is she going to do that? Well, Bank of England is started, so she has no choice. So what do we do in the meantime? In the meantime, we wait, okay? If she doesn't do it, then the market's going to come down a minimum of 20%. It'll come down here, 14 to 20%. If she does QE, then the market will go up probably another 40%. So that's why it's going sideways like this. This is why you got this, really, this area right in here right now. It's even smaller than this, because they're trying to make a decision what to do. So what we're doing is making small trades in here right now. Okay? So that's it. So the market dropped. Remember, it took 18 months. The last time the market dropped in 2008, it took 18 months to go down 50%. The great crash, okay, was the market went down 90%. Okay, in about 3 years. So the next crash, we're going to go down about probably about 60, 50, 60, 70% in maybe about a month. So, but they're going to do everything they to hold it up until after the election. So if they break it out with more QE, we're going to have a lot of great buying opportunities. Once Hillary has beat Trump, which he's going to, we can see that already, then what's going to happen is then the market will collapse and we'll get our big pullback, okay? And a big pullback. It's going to be much worse than it was in 2008, which was 50%. And it'll probably be as bad as it was in 1929, because we've never seen a market pumped up with all air. That's the problem. All right, so you got a lot of great opportunities, and that's why you should join the gang, so you can learn when the market does collapse, like the last two collapses we had, we were nice and short, making money on the way down. So join my gang. We got brand new software, okay, beautiful software here. Okay, we just designed a new product, MV1 and MV2. This is a color code, tells you when to buy, when to sell. All right, hope you enjoyed this, brought you up to where we are with the market. Just join my gang, Phil's gang, and we'll keep you up to date every day. Okay, see you in the charts.